Yes, yes.
Press on with Lord Hamilton.
I will declare my interests as the director of an investment trust and indeed two international property funds. Can I just take you up on... I'm a bit confused about this post-trade and pre-trade. When I ring up my stockbroker on rare occasions, he can tell me on any individual stock what trades have been done within half an hour or something before I talk to him. I mean, he looks them up on his thing and says 100,000 shares changed hands at 100p. Does that fulfill the requirements for post-trade transparency?
That will only tell you whichever venues he subscribed to. So if he subscribed to the stock exchange, if he subscribed to one or two of the MTFs, he would be able to give you the information on the data he subscribes to. What he doesn't have is access to all of the venues that would have traded that stock in the last half an hour. So what we would like to see is a consolidated form of data, that you wouldn't just look at where he is subscribed to their data or subscribed to their venue, that we could see the data across the whole spectrum. And with 138 MTFs, I suspect there's an awful lot of prices he doesn't see.
Quite a business gathering them all together. On pre-trade, markets move. So if I say to you, yes, you can have these at 100p, but I can't guarantee that price for more than 3 seconds, because it may well be that it moves. I don't understand how you deal with pre-trade transparency if you're talking about a moving market where the price goes up and down.
Well, there's two dimensions to this. There is the actual information and there is the ability of dealing. The actual information here again is about A, do we want it, and B, do we have the technology to consolidate the best bids and offers in the whole market at any point in time. And as MiFID I led to a fragmentation of the market, there's clearly a big technological challenge there to make sure that we have all best bids and offers at all points in time. But that's feasible, provided, we want to do it. And then there is the execution dimension of, are you going to get the best bid or offer, depending on whether you're looking to buy or sell. And then behind that, you have many issues. One of them is algorithmic trading, because obviously when you have so many trading venues, it cannot be done by hand. You need the clever algorithm that will take your order to wherever the price is better. Okay, that's one dimension of it. But the other dimension, looking at the same problem from the other side, from another angle, is that we have built a system where we fragmented markets and therefore price diverged as could have been expected. And then we have a system that brings prices back in line. So yes, I know we cannot go back in history, but did we need to fragment markets and make prices diverge to make them converge again? And that's clearly a big question, and especially in the light of the fact that, yes, the cost of transactions, the cost per transaction has gone down thanks to that market fragmentation, but the cost per value, if you want to buy the same amount of money worth of a stock, has gone up. So that's very interesting because, many of the trading costs and clearing costs and depository costs are per transaction. So when you think in per value terms, following MiFID I, the cost of the transaction has gone up. So, there's many things behind your question, but I feel those are the main points. And it is essential that your broker should have the right technological means of accessing the markets. If we link that, and I know it was not the main purpose of your question, to the question of algorithmic trading and high-frequency trading, a distinction must be made, and it was not made clearly enough in the proposal from the Commission between algorithmic trading and high-frequency trading, which are not the same thing, HFT being a subset of algorithmic trading, but not having the same purpose as the algorithm that your broker should and could have in order to execute your order in a professional manner.
Thank you very much. I don't understand that much better, I think. Very good. What is your view of the proposal to introduce a new category of organised trading facility? Is this needed?
Let's define what an OTF is first. We know that MiFID I created the MTF, Multilateral Trading Facility. I would define the organized trading facility as an MTF with, on top of that, the discretion to execute orders or not to execute them for the broker, and the discrimination of allowing customers on the platform or not allowing them. So my definition of an OTF would be a degraded MTF with less constraints and less constraints. What do we need that for? I think the Commission, by proposing OTFs, had a good intention, which is bringing back the OTC market on market or on a regulated venue, which is a very, in our view, very good purpose, a very good objective, because today, if I may diverge for 20 seconds on the issue of OTF, and Case Winberg rightly said that there are doubts and discussions about the size of the OTC market, somewhere between 20 and 40%. But regardless of what the size of that market is, the fact is that more or less half of the OTC market is dealt on standard size or below standard size transactions, and 87%, if I remember well, of transactions are dealt on smaller than large in size transactions. In other words, the purpose of the OTC market has been diverted. I mean, there was a purpose which was, we can deal over the counter if it's large in size, because large in size, can have a market impact, and if you do it on the lit market, your impact is going to be negative, it's going to be bad for everybody. But the reality of the OTC market is that the vast majority of transactions could and should be done on the lit market, but they are done on the OTC market. So the purpose, and coming back to your question about OTFs, the purpose of the Commission by inventing that new category of OTFs was, okay, let's do as much as we can to bring back that OTC market on market, and let's create a new type of venues that is slightly less regulated than the existing venues, but still better. It will be better than pure OTC. In our view, that doesn't serve the purpose, because either we're going to have regulatory arbitrage and we will see MTFs sort of degraded to OTFs, which will serve nobody, in our view, or nobody will use them. The right way of addressing the OTC situation is certainly not to forbid OTC. There are many situations where OTC is justified, but to give a clear definition of what OTC transactions should be. And in MiFID I, there was no clear definition of what OTC should be. There was a recital 53, if I remember well, that said that OTC should be for large in size, okay? But in the core text of MiFID I, there was no strict definition. And therefore, without violating the law, business has gone OTC because there's more margin in OTC dealing for dealers than in lit trading. But that has been done at the expense of investors and retail customers. So OTFs, in our view, really are not useful and are not the right way of addressing that fundamental issue.
What are they going to happen, though, do you think?